Hello everybody, this is Eddie Ghabour, co-founder of Key Advisors Group. Please subscribe to our YouTube channel for educational videos with our opinions on markets, the economy, and hopefully some tools that you can use to help you and your family get to where you want to be financially. The topic I want to discuss today is really about the Fed and how many rate hikes we're actually going to get. I don't know if I've ever seen in my career, I've been doing this for 24 years now, I don't know if I've ever seen this many opinions that are so far off in regards to what the Fed's going to do. That just goes to show you why the markets are doing what they're doing, because there's a lot of confusion, there's a lot of guessing, and there's really only one group of folks that really know what's going to happen, and that is the Fed themselves. And they probably don't even know how many rate hikes they're going to get. So we've heard estimates of 5 rate hikes. We've heard estimates of 8 rate hikes. I personally don't believe we're going to get anywhere near 5 to 8 without going into a recession, okay? So one of the reasons why we say that is we don't think that the Fed is accurate in where they think GDP is going over the next 2 quarters. We believe that the inflationary pressure that has been impacting the consumer isn't going to really materialize in regards to the data of GDP and consumer spending and retail sales until the second quarter, maybe third quarter of this year. If we get a huge deceleration on GDP and we see the consumer has kind of tightened up because of how inflation has impacted their pocketbooks, and we have a Fed that starts raising rates aggressively because of how far behind they are in the curve in regards to trying to tame inflation, that's where you can have a situation where the Fed is forced to put us into a recession to cool things down. And that's the big risk, which is why we've been so cautious and talking about playing defense really since the middle part of November to where we are now. And until that data changes, we're not going to change our opinion. And so if the Fed truly does raise rates 5 to 8 times, in our opinion, you're going to see an inversion of the yield curve. You know, there's a saying in our industry, and I happen to believe it, that the bond market is smarter than the stock market. And the bond market right now is telling you that there are some things that you need to be concerned about. The yield spread between the 10-year bond and the 2-year bond is starting to get tighter and tighter. So if the Fed raises rates into that, and we have what's called an inversion of the yield curve, where the 2-year rate is higher than the 10-year rate, that many times can be problematic and a sign that a recession is coming down the road. And that's the exact predicament the Fed has put themselves into. Realistically, the bond market right now doesn't seem to be able to handle 2 rate hikes, let alone 5 to 8. So there may be a scenario where inflation just stays so sticky hot that they're going to have to raise rates 3, 4, 5, and God forbid 6 times, put us into a recession, and then start getting ourselves back on our feet. So the reality is this: as an investor, when there is so much uncertainty out there and so many things that could go wrong in our opinion versus that could go right, it is of our opinion that this is the time to kind of scale back. Now, everybody's risk tolerance is different. I'm only speaking on behalf of our client base, that we've taken the position that with so many things that could go wrong in 2022, we're going to take a more cautious stance, and we have, in being more defensively positioned. Now, if we're wrong and the economy booms and the stock market goes straight up, then that will be a big mistake on our part, and we would have been better off not lowering risk for the assets that we manage. But again, I've done this a long time, and the toughest thing is trying to manage volatility. That's something we try to get better at every single day. You're never going to master it, sort of like golf, and that's probably why I love this business so much, is because there's always room for improvement. But as the data comes in every single day, we continue to get confirmation that our opinion may materialize over the second and third quarter, that the economy is slowing faster than many have priced in. And if you have a Fed that is really taking a very tight stance on monetary policy during a big slowdown, is when recessions can materialize. So we believe regardless of what the Fed does, the next 6 months are going to continue to be extremely volatile, and investors need to be very prepared for that. Reassess your risk tolerance and take advantage of big up days and maybe reassess risk and take some off the table. But again, only you can make that decision for you and your family. I'm just sharing with you our opinion. So I hope you got a lot of value out of today's information that we're sending out, and hopefully you and your family make it a winning week. Thank you and have a great day.